Hello students, Dr. Wang is here with a new haircut. In this video clip, we're going to study a new chapter number 3, which is about financial statements and financial ratio. And we are going to conduct analysis based on the statements and ratios. So here are our learning objectives. We know that the financial ratios are built based on the data on the financial statements. So we have to first study well the statements, how the numbers are inputted and how different statements are integrated together. And then we will learn how to use the number to calculate the ratios and what the major type of ratios available for analysis. And then in particular, we're gonna address the liquidity ratios, leverage ratios, and profitability ratios. At the end, we are going to conduct a Duban analysis, which decomposes return on equity into 3 components and see how ROE or return on equity is driven by these components. So of course, when we construct the financial statements, we need to follow the generally accepted accounting principles or GAAP. So this is the way we get the transactions inputted into the database and organize the general journals and then consolidate them into a great ledger. And then we craft the financial statement, for example, income statement, balance sheet, and statement of cash flows, and so on. The income statement provides a financial summary of a company operating results during a specific period. And this period could be a year or a quarter. This statement provides the accumulated number for the variables. For example, in the income statement for a quarter, if you have a sales or revenue, then this sales or revenue is not just for a day, it's not just for a week, it's actually for 3 months or a quarter. So this is an example of an income statement for a fictitious company called Bartlett. And you see the income statement starts all the way from a sales revenue, and then you deduct cost of goods sold, which is your variable cost varying with the number of units to produce. After you deduct the cost of goods sold, you will see this gross profits. And then you deduct these operating expenses or the fixed costs, so which include selling expenses, general and administrative expenses. In certain statements, these two could be merged together as SGA expense, selling, general and administrative expenses. And you also need to deduct rent, utilities, and wages. So this would be in lease expense. And then you have to deduct the depreciation expense. And you know that depreciation expense is not a cash term, whereas all the others are denominated in cash. So after deduct depreciation, you get an operating expense. And when you deduct the gross profit by the operating expense, you get operating profit or EBIT. EBIT stands for earning before interest and taxes. And then you deduct the interest, you deduct the taxes, you have all the net income. We also call it net profits after tax. And then you will use the money in net income to pay off dividends. The preferred stockholder get paid dividend first, and then followed by common stockholders. And the rest of the money, after the dividends are paid, the rest of the net income will be retained to a company's saving account, which is called a retained earnings. Likewise, you can have your own income statement as a person. For example, you may receive a check or salary from your job, and then you have also some savings in the stock market or in the bond market or in a deposit of a bank. You will get an interest and a dividend, so that's your total income. And then you need to deduct all the expenses of your life. You pay your mortgage, you pay your car loans, you pay utilities, electricities, you pay repairs and maintenance, food, healthcare, so on and so forth. and then you use the total income subtracted by total expenses to get your cash surplus or deficit. So if it is positive, then it is a surplus. If it is negative, then it's a deficit. The balance sheet is a different story. The balance sheet presents a summary of a firm's financial position at a point in time. Okay, that's very important. At a given point in time. Although the balance sheet is provided on a quarterly or annual basis, the number there just stands for how much the company has just at that particular date of that quarter or of that year. And the balance sheet reports the company's total assets, which include short-term and long-term, the total capital, which includes debt and equity. And the debt belongs to the debt holders, and the equity belongs to the stockholders or the owners of the firm. And right here, you see the balance sheet of this Bartlett company. We have total assets right here, which is made of short-term assets and long-term assets. So short-term basically are the assets last for less than a year. This includes cash, marketable securities, account receivables, inventories. And then the long-term would be the assets that would endure for more than a year. And these assets would be land, building, machinery, equipment, furniture, vehicles, and so many others. And when you calculate the fixed assets, you need to deduct the accumulated depreciation from the fixed assets to get the net fixed assets. Net basically combines both positive and negative. So that's how you get the net fixed assets, and then you add net fixed to the total current. This would give you the total assets. On the financial side, the total assets equals to total debt and equity. That's what we know. And for debt, it includes short-term debts and long-term debt. The short-term debts are called current liabilities, which include all its payables and accruals. And accruals basically stand for unpaid wages, utilities, and bills. And long term usually refers to loans, corporate bonds, and private placement of debt. And then if you move down for the total equity, you have a preferred equity and a preferred stock. So preferred stock here is having different term than common stock. So here are the specified coupon rate or dividend rate, the par value, and the number of shares outstanding. And for common stock, there's also par value and the number of shares outstanding. The thing is, for common stock, there's no fixed dividend ratio. Unlike right here, you have a 5% dividend ratio. Right here, you have none. So that means for common stock investors, there's no guarantee of their dividend income. And then you have this retained earnings. As I said earlier, this comes from years and years of savings of company's net income after dividend. So after you get the total equity, you have this total liabilities and equity, which happens to be your total assets. And here is a brief view of a person, not a company. So for a personal finance, you have a cash, you have a checking account, which includes your money in the bank, and also saving accounts, money market funds. So these are short-term investments. You also have stocks and bonds, mutual funds, and all types of long-term investment. And you also have a real estate, which is your house, your cars, your furniture, the jewelry, and stuff. And then on the other side, you definitely have your personal belongings, which is your net worth. Okay, that's how much money you have in your pocket, which belongs to you. You also have all these liabilities from a credit card company, from a utility company, and a hospital, either in short run or in the long run. And in the long run, you have different loans. You have a mortgage loan, which is pretty significant. You have car loans, education loans, and so on and so forth. So altogether, this would add up to your total liabilities and equity. So another financial statements here is a statement of retained earnings, or we call it statement of owner's equity. So retained earning is a very important concept, and I want you guys to remember it. Retained earning of this year equals to retained earnings of last year plus net income this year minus the dividends of this year. So basically, retained earnings is years and years of savings of a net income after dividend. So this is something I repeated here. So you have this return earnings, uh, and that's from the last year or at the beginning of this year. And then you add the net income, you deduct all these dividends to get return earnings at the end of this year. Another one is statement of cash flows, and statement of cash flows basically record how cash flow changes based on different activities, and these activities could be divided into investing, financing, and operating activities. And each item on the balance sheet, okay, if these items change, then there should be a item on the statement of cash flows. And for more details, just to work on your first financial project in Excel. In that project, you are instructed to construct a statement of cash flows based on balance sheets and income statement. So here is a view of a statement of cash flows. You can see that there are three major categories: operating activities, investing activities, and financing activities. And you will see the change in account receivable, inventory, account payable, accruals. These are all items on the balance sheet. So is gross fixed assets, change in equity investment, notes payable, long-term debts, and these are all in balance sheet as well. So what are not on the balance sheet is net profit after taxes, which is net income, depreciation, and also dividends. So if you combine net profits and dividends together, so net income minus dividend would be the change in retained earnings, and the change in retained earnings is also part of the balance sheet. And this depreciation is coming from income statement. The thing is, depreciation also represents the change of accumulated depreciation, which is an item on the balance sheet. So the bottom line is everything here is derived from the items on the balance sheet. The thing is, certain items there could be replaced by items in the income statement. Okay, so here is a review for the key terms of income statement. So first of all, you should know that earning before interest and taxes is also called operating income or operating profit. So to get this operating profit, you need to get the operating revenue minus all the operating expenses. And then you have an interest payment before tax payment. That's very important. So that basically determines our interest is a tax shield to avoid taxes. And also part of the net income, or this is called tax net profit, goes to dividends, and the rest of part of net income goes to retained earnings. And the key terms on the balance sheet, first of all, you need to know that total assets always equals to current assets and fixed assets together. And accumulated depreciation is depreciation expense from income statement, okay, plus the accumulated depreciation of a previous year. So that's why it's called accumulated. And total equity could be divided into preferred equity and common equity. For simplicity, let me just skip preferred equity. So if just for common equity, it would be a common stock plus retained earnings. And retained earnings, as I said many times, equals to the retained earnings for the previous year plus net income minus dividend. So it's like your contribution for retained earnings in this year. And there's also a concept called net working capital, and this equals to current assets minus current liabilities. When you construct statement cash flows, you need to report the impact of firm's activities on cash flows. And the activities could be grouped into these three categories, as I mentioned. And very importantly, on the balance sheet, if assets increases, then cash should go down, right? Because that means you spend cash to build the assets. Like you buy yourself, you buy yourself a cell phone, then your assets for the personal belongings would increase, but your cash would drop because you have already spent that money. And if liability or equity increases, then your cash would also increase. So if liability increases, it's like you borrow more money. With no other things happening, you have more cash in your pocket, right? Likewise, for equity, if you issue more stock or save more money, you have more cash in your pocket. And if you look at this universal accounting equation, total assets equals to total equity plus total liabilities, that also means the change of total assets from last year equals to change of equity and the liabilities from last year, right? So if you use 2019 minus 2018, the change is the same for total assets and the total equity and liabilities on both sides of the equation. Therefore, the change of cash plus the change of non-cash assets equals to the change of equity plus change of liabilities. So your total assets is made of cash and non-cash assets. I just simply divide them into two parts. And then if I move this change of non-cash assets to the right-hand side of the equation, so change of cash equals to change of equity plus change of liabilities minus change of non-cash assets. That basically says if non-cash assets increase, cash would go down to the opposite direction because the sign here is negative. And if equity or liabilities increase, then cash would also increase to the same direction because the signs here are positive. And the change of cumulative depreciation equals to a depreciation expenses, as mentioned earlier. Change of retained earnings equals to net income minus dividend, as I mentioned earlier in that table of balance sheet. If you put a net income and depreciation together, that is to recoup the non-cash cost on the operating side. So think about that. Depreciation is a non-cash term, right? To get net income, you deduct that non-cash term, right? From sales, from operating expenses, and then you deduct the depreciation. And then if you add the depreciation to the net income, then that will be sales minus operating expense in cash minus interest in cash minus taxes in cash. So the sum of these two numbers would be a cash term. So that's why we call it to recoup the non-cash cost. Here is a practice question. True or false? Depreciation expense is not a cash term and therefore should not be on the statement of cash flows. Well, depreciation expense for sure is not a cash term. This part of the statement is correct. However, depreciation is on the statement of cash flows because depreciation represents the change of accumulated depreciation, and we need depreciation and net income together, all right, when we put these together to get operating cash flow, which is sales minus operating expense minus interest minus taxes, and all these four components are cash. All right, so we do need this depreciation to be on the statement of cash flows. All right, the next one is interest and taxes are cash paid by the company and therefore should be on the statement of cash flows. Well, it's true that interest and taxes are cash paid by the company. The thing is, you cannot find these items on the statement of cash flows. The reason is net income already represent interest and taxes. So net income, as I said earlier, is a sales minus operating expenses minus interest minus taxes. So net income is after interest and taxes are deducted. So if you have net income on statement of cash flows, you don't need to put interest and taxes again. So therefore, you don't see these items on the statement of cash flows.